merchandising operations series, in which we'll be talking about income statements and business evaluations. So the first thing we'll look at is a very simple income statement, one you're most familiar with, which is called the single-step income statement. And if you look at it, it's a simple listing of your revenues and your expenses give you net income. Now notice in the revenues section, they're also including those contra revenues. Because they are revenues, they're just contra revenues, meaning they effectively reduce our net sales revenue. And then from net sales revenue, we'll subtract our total expenses to get net income. Now some companies will use a more detailed income statement called a multi-step income statement. Now here, the revenue section is just the same. Sales revenue less the contra accounts gives me net sales revenue. From net sales revenue, we'll actually subtract cost of goods sold, because that, again, as we mentioned earlier, that's typically a business's largest expense. And subtracting that from our net sales, we'll get what's called gross profit. Gross profit tells us, okay, this is the amount that has to cover all of our operating expenses and any other revenues and expenses, and give us the net income or the profit that we want to have left. So from gross profit, we'll subtract our operating expenses to give us what's called operating income. And then from operating income, we'll subtract other revenues and expenses, which we've talked about earlier. Those are things like interest expense, or maybe even interest revenue, and that will give us our ending net income. So let's look at some business evaluation ratios here. The two we're going to look at briefly is the gross profit percentage and the inventory turnover. So let's look at the gross profit percentage first. The gross profit percentage is the percent of sales that's available to cover their expenses and provide a profit. This ratio is closely watched by potential investors for any small increases or decreases. The way we calculate the gross profit percentage is taking our gross profit, which you found in the MultiStep income statement, and divide that by our net sales. That will give me my gross profit percentage. The second method to evaluate a business that we're going to look at is inventory turnover. Inventory turnover will tell someone how rapidly this company is selling their inventory. A higher inventory turnover is more desirable, and the higher the inventory turnover, that typically means there's increased profits. To calculate inventory turnover, the formula is cost of goods sold divided by your average inventory. So we also have to calculate average inventory. So to calculate average inventory, we're going to take our beginning inventory, the balance in our beginning inventory, plus our ending inventory, and divide that sum by 2. That will give us our average inventory. Divide that into your cost of goods sold, and that's your inventory turnover. So let's look at an example of these two ratios here. Networking Systems earned sales revenue of $65 million in 2009. Cost of goods sold was $33 million, and net income reached $8 million, the company's highest ever. Total current assets included inventory of $3 million at December 31st, 2009. Last year's ending inventory was $4 million. The managers of networking systems need to know the company's gross profit percentage and rate of inventory turnover for 2009. Compute these needed amounts. So let's start with gross profit percent. Remember, our formula is gross profit divided by net sales. So the first thing we have to recall is, how do we calculate gross profit? Well, remember, gross profit is your sales revenue less any contra revenue accounts, gives me my net sales. So there's the net sales formula. From net sales, we subtract cost of goods sold, and that gave me gross profit. So the first thing we have to do is find our sales revenue. They tell us that was $65 million in the first line of the problem. They did not mention any contra revenue accounts in the story, so we assume there aren't any. So sales revenue is the same thing as net sales, $65 million. From that, we need to subtract our cost of goods sold, which they tell me in line 2 is $33 million, and divide that by my net sales of the $65 million. That will give me a gross profit percentage of 49.2%. What that's telling me is 49.2% of my net sales will become gross profit. That means about 51% of my net sales is actually going to cover cost of goods sold. Depending on the industry of the business, it could be good or bad. Again, we can't immediately say this is bad or this is good without doing a little bit more research into the industry of networking systems. Now let's take a look at inventory turnover. Remember, inventory turnover is your cost of goods sold divided by your average inventory. We already know cost of goods sold. We've looked at that earlier. It's $33 million. But now we need average inventory. Remember the formula for average inventory is your beginning inventory plus your ending inventory divided by 2. Well, they tell me that my ending inventory is $3 million. But they also tell me that last year's ending was $4 million. Well, recall that the prior year's ending is this year's beginning. So our beginning inventory would be $4 million plus our ending of $3 million, $7 million, divided by 2 is $3.5 million. Divide that into your $33 million of cost of goods sold, and that gives you an inventory turnover of 9.43 times. So what that means is we completely turn over our inventory almost 9.5 times this year.